Thursday, the 19th of December. This is the Morning Blast with myself and Mr. Michael Brown. I guess it's the penultimate of the year. 1 second, Mr. Brown. Sorry, just adding you now. Boom, boom, boom. Invite to co-host, Mr. Michael Brown. I believe you've got an invite sent. Let me just double check that actually. I'm not sure. Oh. Sorry about that. 1 sec. Oh, God, 1 sec. Something's not playing ball here. Technical difficulty. Have you got? Is it not sent you the link? No, 1 sec. I'll try again. Invite to co-host. Maybe I'll do it that way. Is anything gone your way? Can you hear me, Mr. Michael Brown? No?
Good morning.
Morning.
Ryan, you are there.
Oh, about time, mate. About time.
What do you mean about time? I've been here for about 2 minutes now, and I couldn't hear a word you were saying. If
really?
Indeed you were even talking.
I was. That's very odd. Oh God, I hope it's not going to be one of those days for spaces because I got free today. Oh no. Anyway,
Can we have a thumbs up from someone if anyone can actually hear us?
Yeah, fuck them. I was just thinking, right? This is our I'll use me words in a second. This is our penultimate show of the year, I reckon.
Yes, indeed it is. I think we probably call it for 2024 after tomorrow, don't we?
So I best do the legals very sharpish and very well today then. Nothing discussed on this Spaces session constitute trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Traders PIQ or PIQ Suite, or indeed the hosts, which as you know by now is Mr. Michael Brown, and myself, Mr. Ryan Paisley. Yeah, I'm assuming people can hear us. Did anyone give a thumbs up?
Yeah, Mr. Zach Eisman did give us a little thumbs up. So
I'm sure Mr. Rich Bernard would be on the WhatsApps as well as Tom and Chopper, if not. But yeah, so what's been happening, my friend?
Indeed, yes. Good morning, everybody. I guess we should probably start with the FOMC last night, who delivered what I suppose we should really be calling a hawkish 25 basis point cut. And actually, I would argue it was probably as hawkish a rate cut as it was possible for them to muster up. So they did indeed deliver that 25 basis point cut that consensus had been expecting and that money markets had fully discounted. So the target range for the Fed funds rate now stands at 4.25% to 4.5%. And that also means that we've seen the Fed deliver a cumulative 100 basis points worth of easing over this year. That decision to deliver a rate cut, though, was not a unanimous one. Cleveland Fed President Beth Hammack instead dissenting in favor of holding rates steady. Accompanying the rate decision was a policy statement that was broadly a reiteration of that issued after the November decision, although the Fed did add in a line relating to determining, and I quote here, the extent and timing of further rate adjustments, which Chair Powell confirmed in the post-meeting press conference is language that signals that the committee are at or close to a point where it may be appropriate to slow the pace of further rate cuts. And that was really the theme of the rest of the decision, whether you look at the summary of economic projections or what Powell was saying during this press conference statement or the question and answer session. It was really all about teeing the market up to be ready that the Fed are not going to be cutting rates at every meeting in 2025, that risks around the economic outlook are significantly more two-sided, and as a result of that, risks around the monetary policy outlook are more two-sided next year as well. Of course, a lot of focus fell on the Fed's dot plot. The median expectation for the Fed funds rate in 2025 that had previously pointed to a further 100 basis points worth of rate cuts next year. That dot now implies just 50 basis points worth of cuts in 2025, followed by a further 50 basis points of cuts in 2026, a 25 basis point cut in 2027. So all of that more hawkish to the tune of 50 basis points than the dot plot that was issued after the September meeting, though that must, of course, come with the caveat that the dots are by no means set in stone or a sort of concrete path as to where Fed policy is going to go, and they are, of course, subject to change. The Fed also revised higher their expectations for inflation throughout the forecast horizon, now seeing PCE, headline PCE, inflation and core PCE inflation both returning to 2% in 2027 compared to the prior expectation of 2026. Those forecasts are not entirely conditioned on what President Trump may do once he takes office. Powell said at the post-meeting press conference that some participants added potential Trump changes into their forecasts. Some explicitly said that they did not do that, and some on the FOMC didn't actually comment on whether they did that or not. So a little bit of a mess in terms of those forecasts, and I certainly wouldn't be reading too much into them. In terms of the remainder of that press conference, again, it was all about just building in greater optionality to the policy outlook for next year. And Powell, again, really clearly outlining the Fed's reaction function. And as we discussed yesterday, Ryan, you don't need to, try and overinterpret and read between the lines here. Powell has basically told us what the Fed are going to do next year and how they're going to approach the economy. And this is exactly how they're going to do it. There are two potential scenarios, and of course this comes against a backdrop of monetary policy being, quote, well positioned. The first is a scenario where the Fed can dial back restriction more slowly, and I'm using Powell's words here, if inflation is not moving sustainably towards 2%. The second is that they can ease more quickly if either the labour market weakens unexpectedly or if inflation falls more quickly. So actually interpreting US economic data and the implications for the policy outlook is going to be pretty damn easy, to be completely honest with you, over the next 6 months or so. If inflation moves higher or if inflation proves sticky, the Fed are just going to skip a couple of meetings. If inflation, just very quickly, if disinflationary progress speeds up, or if we see non-farm payrolls growth roll over, or if we see unemployment rise north of the Fed's forecast, which is in at 4.3% for the next 3 years, then they're going to ease more aggressively. It's really not hard to get your head around that.
Central Bank 101.
Absolutely. Nonetheless, though, it must be said, the market didn't particularly like what it heard. The S&P 500 ending yesterday down by around about 3%, which was the biggest Fed day drop in over 4 years. The Nasdaq slumping by 3.5%, and the Dow, which was long overdue for retirement, that did nonetheless notch a daily decline for the 10th day in a row, which is the longest losing streak for the Dow since all the way back in 1974. We also saw hawkish. I was going to say that was probably just after Dickie Matthews had started in the markets, but I don't think he's on the call this morning. We also saw that hawkish reaction elsewhere. Treasuries.
Sorry to interrupt again. Just a quick fun fact on this sell-off that we saw yesterday in equities. I believe it's in the S&P, in the SPU, 8 out of the last 10 Fed meetings where we've seen a sell-off in equities, the Thursday has retraced the Wednesday move.
Well, actually, I'm glad you brought that up. I didn't have the exact
that's something I read on
statistic on it, but I did write in my note this morning that my gut feeling is that this has gone to a sort of massively over hawkish extreme, and that these moves are there to be faded.
It's a generational buying opportunity, in my opinion. Not that there's any advice. Do not do that. Do not do that.
No, please don't trade on the back of what we're saying. But no, I think you're right. A 3% decline after Powell says everything we already knew he was going to say is just stupid. Anyway, we did see that hawkish reaction elsewhere. Treasuries selling off across the curve, the 2-year rising by about 10 basis points, the 10-year vaulting north of 4.5%. Predictably, that putting a bid into the dollar, the Dixie back above 108. Bloomberg's dollar index, which is a little bit more evenly weighted. That rose to its highest level since November of 2022. Cable came back under 126, the euro back under 104, the Aussie and the Kiwi down by about 1.5% apiece. Again, these moves feel a little bit overdone, to be completely honest with you. Yes, I'm still bullish, but again, just we've come a long way in a very short space of time in a very thin market. And we also saw gold coming under pressure yesterday as well, down by about 1.5% after the Fed decision and testing $2,600 an ounce to the downside. In terms of other bits and bobs, just to cover off very briefly, there isn't actually too much. Obviously, we did hear from the Bank of Japan overnight. They kept policy rates unchanged at 0.25% in an 8-1 vote. Tamura was in favour of a 25 basis point hike. The commentary surrounding that decision was relatively dovish. Ueda at the press conference not really showing any likelihood of being in any sort of hurry to deliver another rate hike. We've seen dollar yen absolutely tear higher as a result. Dollar yen trading, yesterday we were trading before the Fed around 153.75. As I speak, dollar yen is just testing the 157 handle to the upside. So a pretty chunky move there.
Just on the yen, I posted a piece. I think it's Bank of America put out a little kind of anecdotal kind of little fact. I think since the MOF and the BOJ have started getting involved in kind of tinkering in their recent spate, the gap between interventions averaged 12 weeks, and we're now at 19 weeks since the last intervention from either the MOF or BOJ. So they were saying, potentially we could be seeing some. This now's the time, but they did caveat that with it be surprising if they did it over the Christmas period. But as you said, there is a meeting on Christmas Day.
Yes, Ueda is speaking on Christmas Day, so do of course bear that one in mind. We've also just heard from the Riksbank about 10 minutes ago as we came to air. They delivered the 25 basis point cut that markets had been expecting. Do believe, and I only saw this headline in passing, so forgive me if I've got it wrong, that they delivered marginally more hawkish guidance than expected, flagging that they will likely only cut rates once in the first half of next year. I think the market had previously been penciling in 2 cuts. And last but by no means least, this is another headline for the technology-focused people out there. Apple, apparently they have given up on their efforts to build a hardware subscription service for the iPhone. If anyone knows what that means, then please let me know. But otherwise, from this iPhone to your iPhone, Ryan, I'll pass back to you.
Thank you very much, my friend. So a few headlines via our dear friend Zach, who I believe is listening. Yeah, hello, Zach. So in the macro world, US Congress has 2 days to avert a partial government shutdown after President-elect Trump rejected a bipartisan deal late on Wednesday and demanded lawmakers also raise the nation's debt ceiling before he takes office next month. China's biggest. Sorry, go on.
Sorry, Ryan. I was going to say just on that.
Yeah.
It may just be me, and it's coming into Christmas, and I sort of take my foot off the gas a bit. But this potential government shutdown, I know we go through this rigmarole a lot, but it doesn't seem to have actually taken that much by way of attention.
Well, considering
it's gone under the radar a bit.
Yeah, normally people are like screaming, "Oh my God, the US is going to crumble!" Like 2 weeks before the shutdown date. It feels like this one is potentially the closest we've ever got, and no one's talking about it.
Yeah, it's a bit weird that, but
really. But it's an interesting one. Definitely want to keep an eye on. Also, with Trump coming in, it does add a bit more spice to the environment.
Yes,
but China's biggest oil. Sorry, you talking to me? Hello.
No, I said yes. That's very true.
Oh, cool. China's biggest oil refinery said the country's gasoline demand has peaked last year and the declines would accelerate as a shift to electronic vehicles gathers pace. There was chat about this earlier on in the year, actually, about we could see peak gasoline use in China and potentially the Western world following suit. So one to watch on the commodity space. China's booming coal production is running well ahead of demand at the onset of winter, leading to swelling inventories and plunging prices that analysts forecast will fall even further. That's according to Bloomberg. In Germany, Alice Weidel, the long-shot chancellor candidate from the far-right Alternative for Germany, slammed the EU for destroying the country's auto industry and proposed winding back the bloc to a free trade zone. That's one obviously keeping on with obviously the German government and elections and all that kicking off. A couple of geopolitical headlines for you. Corruption in China's military may have disrupted its progress towards its 2027 military modernization goals. That's according to the Pentagon in its annual report on Beijing's military that was released yesterday. Vietnam wants to expand its international defense cooperation to build trust and prevent wars, according to its prime minister. The United States have already come out and said that they're hopeful that this will be the US's defense industry will play a key role. So one for defense names there for you to keep an eye on. In the Middle East, Israel's long hand, quote unquote, will reach the leaders of Yemen's Houthi movement. Defense Minister Katz vowed on Thursday, after unleashing airstrikes in several areas of the Arab country overnight. And a couple equity headlines for you that stand out. Speaking of Apple, you mentioned Apple. Apple is in talks with Tencent and TikTok owner ByteDance about integrating their AI models into iPhones sold in China. That's according to sources. That's sent shares of Baidu lower in Hong Kong trade. Talks between Volkswagen and the labour unions over plant closures and pay cuts are expected to last well into Thursday, as both sides still have not reached a deal. They'll be desperate to do one before Christmas because everyone likes a Christmas break. And finally, from me, Glencore has emerged as an active buyer on spot oil cargoes from the Middle East this month as the merchant starts procuring crude for its Buckham refinery in Singapore. That's according to traders. And back to you in the studio.
Good stuff. Thank you, Ryan. Right, in terms of the day ahead, then, we have two policy decisions due as we round out what has been a monetary policy bonanza over the last 18 hours or so. In about 15 minutes' time, at the top of the hour, we hear from the Norges Bank. We're expecting policy there to remain unchanged at 4.5%, with the key focus being whether the Norges Bank's guidance continues to indicate that they will deliver a rate cut in the first quarter of next year. Meanwhile, at noon, we have a policy decision due from just down the road on Threadneedle Street, the Bank of England, set to hold bank rate steady at 4.75% in what's likely to be an 8-1 vote, with DINGRA likely to dissent once more in favour of an immediate 25 basis point rate cut. Of course, just to recap, this week's UK data, which showed hotter than expected earnings growth and a relatively hot inflation print as well, has really killed stone dead the chances of any BOE action this week. The accompanying policy statement, that's likely to reiterate that the bank will take a gradual approach to delivering further policy easing, while remaining focused primarily on signs of inflation persistence within the UK economy. This is not a meeting where we get a monetary policy report, so there is no but Governor Bailey press conference scheduled, although do just bear in mind that he may appear on some TV networks, and those post-meeting interviews, if they are to occur, they usually pop up around about sort of 3:30, 4:00 in the afternoon London time. Moving into the afternoon session, we've got a few notable releases from the United States. I'm not sure any of them will be particularly market moving. We have the final read on third quarter GDP, which is expected to be unrevised, pointing to economic growth of 2.8% on an annualized quarter-on-quarter basis in the 3 months to September. We also have the December manufacturing survey from the Philadelphia Fed, and also at 1:30 the weekly jobless claims figures. And of course, bear in mind that the initial claims print that pertains to the December non-farm payrolls survey week. And that US labour market report for December is, of course, due on the 10th of January. We also have existing home sales data due from the United States at 3:00 this afternoon. And of course, although the Fed do remain in their post-meeting blackout period, market participants will continue to digest last night's hawkish cut from the FOMC. The only other thing to bear in mind is earnings. We are really to the back end of reporting season, but I'm going to just do it anyway. We hear from Nike after the market close, and we also hear from FedEx, and we will see whether or not they can deliver. And that is pretty much it from me this morning. Ryan, you're on mute.
Sorry, I was blowing my nose. I saw that pun.
Oh, I thought you were giggling at my pun.
I saw that pun coming a mile off. I mean, it was so telegraphed. Well, thank you for that, my friend, on our second to last show of the year. Listeners, thank you as always for tuning in. It's been a very successful year for this, so we're very, very happy with you lot. So thank you very much. obviously it's the PIQ Christmas beers tonight, so everyone's invited. You're just gonna have to find where it is yourself. And we'll see you all tomorrow, where I will be very, very hungover. See you later.
Indeed. Goodbye.
Bye. What's that groaning?
That's me getting up out my chair.